With this whole Instagram phenomena, become a day trader, there's a lot of interest in making fast money, quick money. There are a lot of coaching institutes, influencers. This whole ecosystem has gone to a different level since COVID. What's your take on somebody who's 22, 23, who wants to build a career in stock markets, or somebody who's relatively in late 30s wanting to enter stock market as a full-time career profession? How to do it, what to consider, what not to consider, and what is the right expectation from a career growth point of view given the nature of the industry?
Yeah, so I'll answer it in two ways, right? One is to get a job in this space, what you have to do today, and also maybe philosophically what has to be done, right, to sort of build your own products. The first thing here I think that has changed in the last 10 years is, earlier people used to do this CFA level 1, 2, 3, right?
We also
done that. You study balance sheet, P&L, and you're a CA, and I can analyze companies, read P&L, balance sheet. A lot of people can do that. With these machines, you upload a balance sheet, I think you'll get a lot of intelligent outputs yourself, right? Then you have chartists, technical analysts. I think the single biggest skill set today, even for a value investor, that you can possess, and if you want to enter this industry, is the ability to code, either in Python or any language that a machine can understand. I think it's important. For example, even in Agreya, almost everything we do, we try and test it, right? And the only way to test it is to pull the data out and then write some codes and do it. So I think that is paramount for anybody, even if you're a value investor, to sort of understand how coding, machine works, etc. Right? In terms of developing a philosophy on your own, markets are brutal, and the approach you should have is, there are no holy cows, right? You should question everything, because till 60-70 years ago, value investing was thought to be the only way you can make money. If something is worth 100, you buy for 70, people are rational ho jayega. Once the data started coming out, people said there are factors, there are momentum, there is size, there is quality, etc. So what I'm saying is that whatever books you are reading and whatever you are listening to, influencers, YouTube, people like us talking and saying ye karo, wo karo, I'm saying question everything and test out everything, and only take those that stand the test of data and testing. And once you're saying, okay, this was the hypothesis and this has been proven right, then you keep that nugget of wisdom with you and move on to the next one and move on to the next step. So your palace of conviction in markets and what to do in markets has to be built brick by brick, and none of that brick can be borrowed. You can get ideas, but you have to test, place one brick and slowly sort of build up. It'll probably take 8-10 years, but then your understanding and the commitment with which you can stick through the process when the timing is bad is that there is no other alternate way to build this.
Sure. So basically start from the scratch, do your own stuff, build your own philosophy,
correct,
and to each his own. So it's a very personalized approach to investing and building a career.
Correct.
And don't just go by what everybody has to say.
Correct.
Interesting. And derivatives, because India has become a huge derivatives market. We all keep hearing about it. On the equity side, it's gone bigger and better.
Yeah.
What's Agreya's philosophy on that, and what's your take on that? How will it flow into PMS business? SIFs are also coming into play. So there's lots happening in this entire space as well. So
yeah. So I'll also marry that to your question on quant and AI, right? But it's easy to believe what the machine says. But I think for everything in investing and trading, Ankit, you need a philosophy, right? Philosophy are those legs that allow you to stand and say, okay, data is saying this, I believe it, or data is saying this, I don't believe it, right? How do you have the conviction to believe what the machine is saying? Has to stem from your own philosophy. It can't be borrowed. Otherwise, you'll not have conviction, right? I'll give you an example. I joined in HSBC, it was 2007 at the peak, right? On the trading desks, and there were a lot of experiences. One of them was the yen crashing during the 2008 crisis, right? And we saw what was happening to Lehman Brothers, right? And I remember another incident where I was on the phone, 9:15, CNBC was on, and suddenly this anchor is reading from the paper that Satyam ka incident where he says, I was riding a tiger, right? And Satyam used to be that company which used to be very well respected on campus. They used to come for campus placements, right? Then what happened to Dollar Swissy, right? I don't remember now, but I think it was some 16 Sigma, 15 Sigma event where
7 or 8 big figures.
7 or 8 big figures move.
Yeah.
And those are my formative years in the market, right? So where I was coming from, it seemed that the market is a crazy place, that anything can happen, right? So what you have is a map, right? You are not seeing the world. World is way more complex. So that was my takeaway. That and later on, there's a famous quote by Bill Eckhart which says the variance of the market is infinite. Which means what? That you give enough time in the market, you will see everything. You will see a 20% fall, you will see a 50% fall, you will see an 80% fall.
We've seen that in COVID as well.
Exactly, right? India market is still very young, 35-40 years. हमने कुछ देखा ही नहीं. I mean, US has seen wars where the market was shut for 6 years. So our philosophy comes from the fact that anything is possible, right? When you have that philosophy, what you primarily want to do, especially in derivatives where the risk return is extended, is not 1:1, is that you are first a risk manager. So as a philosophy, we never sell optionality, which is probably what 95% of the street does, because that's where the money is, right? We only buy options. So in buying options, the problem is that first of all, you have to get the direction right, which is say a 50-50 call. Even after getting direction right, the market has to move in your direction immediately, because otherwise you lose the value. So philosophically, we are aligned to products where walking in today, I know what's my worst case. You can say I will sell an optionality and I will have a stop loss, but stop losses are also untested in India. Right? If you can't sell, there is no stop, right? How then what is your exchange obligation?
Gap up, market gap down.
Correct. You lose the margin money though, but can you lose more than your margin money? I don't know those systems.
It happened once, no? When the oil went to negative.
Yeah.
Lot of clients lost a lot of money around that.
Correct. So
first of its kind in that day, I thought I should have been in the DD. Why did I leave?
So the philosophy is to do products where I know my max loss, and I know that I'll survive.
Okay.
After that, returns we'll talk about, right? So the same thing happens in this data. Connecting back to the quant question, is that there are a lot of strategies that look good on paper, right? You sell call spread, you'll have a stop loss, you straddle, etc. But you need to understand and have the philosophy to follow them. Right. And I think the derivatives market in India is dangerous. It's good in a lot of ways, because it pulls people into the market and from they diversify onto equities, etc. But anything that where selling is involved in option, I think you should be a little more careful about it.
So these optionalities are embedded in the PMS products, or there's a separate PMS for these options? Or?
No, there are rules on how to use derivatives. For example, you can't leverage, etc. Right? But you can buy to hedge your product, so that is allowed. So while we are using options derivative to explain all of this, our philosophy is the same even in equities, right? So again, it was in debt also. In debt also, if you say we don't take credit risk, so we directly take away any chance of losing money, and then upside we'll keep it open. We'll see, it depends on the rate curve, etc. So I used options as a showcase to our philosophy. First we'll ensure we don't lose it. It could be equities, it could be debt, it could be options.
So debt PMS is something that sounds very exciting personally to me. And hearing it from you, we want to speak more about that. How big are you in that space? The draw for the investors, what kind of returns it gets?
So yeah, again, debt in the last year and a half has been fantastic, right? With the move in rates. Maybe right now is not the best time to do it, but again, these are cycles, they keep going up and down. I believe that debt again, there is a way to play the debt market without just going through ratings. And we have been able to, in one of the products, catch close to 13-14% return, right? On debt plus options. Yeah. But the problem is in equities, right? If you invest in a company and let's say it has 2-3 bad quarters, its stock falls 25%, it's not a digital risk. In debt, the risk is digital. If it's a bad promoter, you lose the entire 100 rupees, right? So in debt, it is very clear not to chase that incremental 1 or 2%. If you want to take risk, you go to equities, right? Debt is, you want to play it a little more smartly. I don't want to be too greedy, but I don't want that 6-7% also, right? So the way we do debt is, again, that's why we take away NBFCs, right? And then try and see if we can structure good papers and try and get close to that 9-10 percentage points.
So an alpha of 3%.
3%. And if you also see, we don't do too many dead deals because we have put so many restrictions now that it's always opportunistic. It's either opportunistic on the borrower or opportunistic on the rate curve where it's headed, right? So it's likely that almost all of our debt portfolio at some point in time is in G-Secs because we just don't have the opportunity and we don't want to chase returns. Right? Though G-Sec has given fantastic returns in the last year.
AIFs and private investment becoming very, very popular and mainstream pre-IPOs.
Yeah.
How is that impacting the investor sentiment? Is that eating into the PMS pool or equity pool, or is that money coming from FD? What's the sense that you have about it?
The AF category 3 specifically, they don't have too much in common. I mean, end of the day, they also do equities, but it's a separate vehicle where the minimum investment is about 1 crore. Right, it has taken off well, but again there are challenges because of the ticket sizes and how to grow, etc. So it's a separate vehicle. I don't think it's cannibalized any of the other investments too much. It's a lot more seamless in terms of documentation. Like today, if you want to open an NRE demat account in India,
it takes ages.
It takes a lot of time, right? I mean, the operational challenges, especially if the NRE is not in India, the KYC that he has to do there, etc. Those kinds of things get simplified. Taxes get simplified. You can do something on the dollar to take away the currency risk, and we've been in the currency market, so we know how rupee depreciates sometimes.
So you've already touched upon the US investment. So I mean, it's getting more and more popular, especially with the younger audiences. They use those products. They use Apple. They know about most of the bigger US brands, and there are apps coming up showcasing those stocks to buy through the apps. How do you think this is going to pan out? Is the market going to become more and more polarized towards, let's invest in part of equity in US markets, part of equity in Indian markets, look at something in Japan with somebody who has not a very large corpus as well, or is it going to be like somebody who has a lot of corpus thinking to diversify outside of India is going to do that?
Prima facie, I think it's a great idea to diversify, right? It gives you a completely new market to invest, and US is a big market, right? I think just 1 or 2 companies there in the FANG is much bigger than a BSE
market cap.
But they also move even more, right? I don't know how they manage that. But from a lot of investors that I speak to, a lot of them in their early 30s start US investing because of the kids' education, right? It takes away the currency risk, it just diversifies. So whether to do it, yes, I'm a proponent of it. How much to do it is up to you. In terms of actual products there, so sitting in India, I don't know what edge we have over people who are already tracking the US investors there. So I would probably stick to ETFs, right? And they give you the US market exposure, and there aren't just 1:1 ETFs. If you already have money outside, you could explore T-QQs, T-QQs, right? For example, if your call is to be bullish on the US and that's why you're investing there in the first place, then an exposure into an ETF which gives you twice of Nasdaq returns is always better, because for the same call which is bullish US, you're getting 2x the returns and you have 10 years. So if you think in 10 years Nasdaq's not going to be higher, then don't invest in the first place, right? If that much of conviction is there, then you might all invest in T-QQs, QQs. So the products are there.
Great.